Hi, thank you for joining us today for this special presentation of Education Minnesota ESI Member Benefits Long-Term Care Insurance Offering. Education Minnesota ESI Member Benefits has partnered with Educator Lifetime Solutions and Newman Long-Term Care in offering sponsored long-term care insurance solutions to Education Minnesota members and their extended families. So together we work with you to uncover your family's specific needs and provide a complete range of long-term care solutions. Our presenter today is Tom Student. Tom is a licensed health and life insurance agent and has been assisting families across the country to protect themselves from the potential financial and emotional impact of long-term care events. His awareness of long-term care came after he experienced firsthand the financial and emotional impact that many families lived through during the illnesses of his grandmother. In need for continual care, his grandmother was placed in a nursing home. So Tom now specializes in long-term care insurance. He is an active member of organizations such as the Park Nicollet Successful Aging Initiative. He also participates in community events and fundraising for the Alzheimer's Association. And he brings to us decades of experience focused on long-term care planning. He is a CLTC designation certified in long-term care planning. He brings his clients a wealth of experience as well from his time as a representative for Genworth Financial and AARP's long-term care plans. So with that, I'm going to hand it over to Tom.
Hello, everyone. My name is Tom Student, as Craig said, and I am a long-term care planning specialist. I've been doing this. I'm in my 22nd year, and about 2.5 years ago, I was approached by the upper brass at our company, and they wanted me to work with Education Minnesota, and I think the reason they might have picked me is because my last name is Student. So anyways, we're going to talk about long-term care today and where people get long-term care, what long-term care is, how do people take care of themselves at that juncture, and answer some of the different questions that people tend to ask me. So, there's me, long-term care planning specialist, and again, we're going to talk about what long-term care is, how do people pay for it, where do they receive care, etc., etc. So these days, people live a long life, where back in the olden days, people used to die from a heart attack, a stroke, or a cancer, but that typically doesn't happen anymore. A lot of times people will have a stroke, they won't die from it, but they'll need care after they have that stroke. Long-term care is not a place. It's actually an event, and it's an event that happens when somebody can't do 2 of the 6 activities of daily living. And those are dressing, eating, bathing, toileting, transferring, which is getting up out of this chair and moving to that chair, and continence. And if you think about those 6 activities of daily living, each and every day, if you get up and take a shower and eat breakfast before you go to work, you've done all 6 of those within, a half an hour of getting out of your bed each and every day. Or long-term care can be an event that happens when somebody has a mental illness, like Alzheimer's, dementia, Lou Gehrig's disease, Parkinson's, head injuries. There are 4 places that people turn to when a long-term care event happens. And the first place that they turn to is through their family. And so usually at this juncture, when I do these workshops in front of a group of Education Minnesota members, I will typically pick out a couple, and I'll use them as an example of how people handle long-term care at the end of their life. And so today we'll just pretend the couple's name is John and Mary. So the first place that John and Mary can turn to when they need long-term care at the end of their lives is to their family, which means John's taking care of Mary, Mary's taking care of John, or you're moving in with the kids, or the kids are moving in with you. It's a great short-term solution for long-term care. The issue is that it's difficult for John and Mary to take care of each other because, they're both 85 to 90 years of age when it happens. And if the burden falls upon their children, they might have one child that lives in Minnesota, They might have another one that lives in California, and they might have another one that lives in New York City. And so typically the care, at least from the family, is going to fall on the shoulders of the one in Minnesota. And the problem with children taking care of their aging parents is a lot of times it can cause family strife and kind of rip a hole or a divide in the family structure. The second way that people take, but it is a good long-term care solution, at least at the beginning, for I'm going to say, the first 40, 50, 60 days, but after that it gets very difficult for your family to do it. So the second way that people take care of long-term care at the end of their life is they do it through the government. And through the government, when you get to be age 65, you have two long-term health care insurance policies. The first one is called Medicare, and the second one is called Medicaid. Now, Medicare is really a short-term health care policy. In other words, John and Mary, they have Blue Cross Blue Shield. They're under age 65. If John had a heart attack today and he needed triple bypass tomorrow, he doesn't dip into his assets to pay the doctor $400,000. Blue Cross Blue Shield pays for that. And when John and Mary get to be age 65, they'll have Medicare Part A, Part B, and their Medicare supplement. There is, however, a long-term care provision to Medicare which reads like this. John gets to be age 88. He falls down and breaks his hip, has a stroke, and he goes to the hospital, and he spends 3 nights in the hospital. Well, Medicare pays to fix his hip and for his hospital stay, and then after that he goes to a rehab center, and Medicare will pay for the first 20 days of his long-term care free and clear. He's got a 20-day policy with the federal government. After that, they'll continue to pay from day 21 through day 100 as long as he is receiving what is called skilled care, which means he's improving. So they waltz into his room on day 21. They say, John, how's it going? And he says it's going very well. And they say, well, that's good because today you need to take 6 steps instead of 5 steps if you want Medicare to continue to pay for your stay. And they'll pay up to day 100. But as soon as John quits improving, or as soon as he gets to day 100, they quit paying, and then he is on the hook, or John and Mary are on the hook, to pay for John's long-term care out of their own pockets until they have spent their net worth down to where Mary is left at home with the equity of 1 residence and also $120,000. And then John would qualify for Medicaid. And John would have to go to a Medicaid nursing home. So wherever they had an opening in the state that he resided in, they could send him there. He'd probably have 2 or 3 roommates, and the people who take care of you pretty much make the same amount of money that you make at McDonald's. Call it jail or camp, whichever makes you feel more comfortable, but that's really what Medicaid is. It's for the impoverished. Now, the reason that they leave Mary with $120,000 in the equity of the home is because they can't kick her out on the street with no money to live on and no place to live. So let's say John gets to Medicaid. He's a ward of the state for the impoverished, and he spends $200,000 of Medicaid's money, and then he dies. They don't come back and ask that from Mary yet, but after she dies, what's ever left of the $120,000 and the equity of the home goes to pay off John's Medicaid bill before it goes to their 2 children, unless they have left those assets outright in their children's name at least 5 years prior to needing Medicaid. The number of years used to be 1 year, then it was 2, then it was 3, now it's 5. They're talking about making it 7, and by the time John and Mary need long-term care in 25, 30 years, they might make it virtually impossible for you to hide your assets in your children's name and get on Medicaid. And the reason that is Medicaid is flat broke. It makes Social Security look like a financial institution built out of gold bricks. So, let's say instead, John, we'll get to that in a minute, but let's say instead, John is one of the lucky 4% that die within 2 or 3 weeks of something occurring to him. And he doesn't need long-term care. And Mary, she becomes single. And let's say, she gets to be age 89, 90, and she falls down and breaks her hip. Again, Medicare pays for the first 20 days of her long-term care free and clear, and then after that, they'll continue to pay from day 21 through day 100 as long as she's improving. But as soon as she quits improving, or as soon as she gets to day 100, they quit paying, and then she is on the hook to use all of her assets, including the equity of the home, until she has spent down to $3,000. When she gets down to $3,000, she would qualify for Medicaid. She again would have to go to a Medicaid nursing home, and if she spent $200,000 of Medicaid's money, and after that she died, they couldn't come back and get any money from her heirs because she had already spent her assets away. One last thing to note, the look-back period of 5 years, if you do it in a trust, it must be in an irrevocable trust, not a revocable trust. There is some controversy right now on whether even having it in an irrevocable trust will make it protected. So it's really leaving your money outright to your children at least 5 years prior to needing Medicaid. So the third way that people take care of long-term care, and that's the slide we're looking at now, is they self-insure. And that's what John and Mary do now. They are their own insurance company, and that's why the amount that they pay for the insurance is $0, because they're the John and Mary Insurance Company for long-term care. On the other hand, if they got a policy that paid for 100% of their long-term care for a 10-year period of time, they'd be more fully insured, and the cost of that insurance policy would be a whole bunch of money. So what most people do is they use the fourth way. They co-insure. In other words, what they do is they get a policy where once they need long-term care, it will pay for 2, 3, or 4 years of their long-term care at anywhere from 50 to 75% of the cost of long-term care. And the reason people do that is it keeps the premium at a level that's acceptable, and also you have to remember once you need long-term care, the chances of needing it for more than 2 or 3 or 4 years is not very high unless you get early onset Alzheimer's. And also, just because you're in long-term care doesn't mean your income stops. You still get Social Security. You still get interest on your assets. You still have to take the required minimum distribution out of your retirement accounts when you get to be age 70 and a half. And all of you, because you're educators, will have a pension. So you have an extra revenue stream. So most of the clients that I work with Education Minnesota, they have that pension, and thus they can do more co-insuring than a couple that does not have a pension. So in essence, what they're really doing is they're using the policy plus their income to pay for their long-term care for a period of 2 or 3 or 4 years, and then that way they can do whatever they want with their assets before they die and after they die. There are 4 major risks that people face during their lifetime to their assets. And those come from your car, your home, your short-term health care, and long-term care. But John and Mary have built a wall of protection around 3 of those. They back out of the driveway tonight. They hit Mrs. Johnson's Lexus. They break her hip at the same time. They don't dip into their assets to buy her a new hip and a new Lexus. Geico pays for it. About 1 in 250 cars need to use their car insurance catastrophically. And same with their home. Even if they owned their own home, in other words, they didn't have a mortgage on it and thus didn't have an insurance policy on it, they'd never go to bed tonight without an insurance policy, because if their house burnt down or got blown down in a windstorm or a tornado, they'd have to come up with several $100,000 to repair that. The chances of you using your home insurance to the tune of $100,000 or catastrophically is about 1 in 1,200. And same with your short-term health care. Today, John and Mary have Blue Cross Blue Shield, and tomorrow, when they get to be age 65, they'll have Medicare Part A, Part B, and their Medicare supplement. So really the last boogeyman in the closet, if you will, that can take large chunks of your assets away from you is the risk of needing long-term care. And in the United States right now, the inherent risk of needing long-term care for a man, if you get to be age 65, is approximately 51-52% of men, And for women, it's about 57% of women will need about 2.5 to 3 years of long-term care before death. People always ask me, why is it higher for women than it is for men? And the reason that is men are typically a little bit older than their wives. Because they're men, they die a few years earlier. And when they need long-term care, he's got a built-in policy, John does, called his beautiful wife Mary, kind of. But when Mary needs long-term care, actuarially speaking, John is typically gone. So that's why it's higher, the chances of needing long-term care for women than it is for men. So the state partnership program. The state of Minnesota wants you to have a long-term health care insurance policy so badly that they're basically willing to make a bet with you. And this law is transferable to all the other states, but they're saying, John, Mary, if you have a long-term health care insurance policy, and let's say when you need long-term care, the long-term care policy is worth $300,000, and you use all $300,000 of that policy and then you die, you are then and you're still in long-term care, so you've used your $300,000, you're still in long-term care, you have to pay for it out of your own pocket once your policy is gone, but instead of having to spend their assets down to $3,000 to get onto Medicaid, they would only need to spend their assets down to $300,000. Now, the reason the state of Minnesota wants people to get long-term health care insurance policies and has made the state partnership law is because they can't afford to see you on Medicaid. Multiple solutions for long-term care. There's traditional long-term care insurance policies, which you buy and pay for each and every year until you need it, you die, or you decide you don't want the policy anymore. So if you have the policy for 25 years and John and Mary both died, they would not send you any money back. It's your least expensive option. This kind of insurance acts just like car insurance, just like home insurance, just like health care insurance. In other words, if you never get in a car accident, Geico doesn't send you any money back. There are newer solutions, and those are called linked benefit hybrid life/long-term health care insurance policies. These are gaining popularity. They are more expensive, but the reason people like them is no matter what, they are going to get their money back because they're either going to die and get their money back as a death benefit, or they're going to need long-term care and get the money back in the form of a long-term care benefit. Tax benefits. Each year in the state of Minnesota, John and Mary will each get a $100 tax rebate from the state of Minnesota. Additionally, if you own your own business, you can write these policies off on a federal basis also. You can also use a HSA to pay for a long-term health care insurance policy with pre-tax dollars. Multiple solutions with multiple companies. I'm typically seeing when I meet with educators, if they decide on the traditional long-term health care insurance policy, they'll typically look at Mutual of Omaha because Mutual of Omaha, not only in my opinion, is the best policy or contract on the marketplace today, but they also pass on an extra Education Minnesota discount that you can get also for your extended family members, like, for instance, your brothers, your sisters, your cousins. If people look at the hybrid long-term health care insurance policies, the three companies that I typically see people looking at right now are One America, Nationwide, and Securian. Senior Care Navigation. Just because you are a member of Education Minnesota, you can call the number in the lower left-hand corner, and they can help you with senior care navigation. So, for instance, if John and Mary, let's say they're 55, and they had some parents that were in the starting process of needing long-term care, and they just didn't know which way to turn or how to start that, they could call up that number at LifeSpark and get the help that they need in order to get their mom and dad the appropriate care. So people typically have questions. They say, Tom, what's the best age to get long-term care at? I will tell you my typical policyholders or people who apply are between the ages of 40 and I'm going to say 65. The best time to get it really is when you're healthy. And the reason that is because not everybody qualifies because of health reasons. So really, the younger you are and the healthier you are, the less the policy will cost. Typically, what I'm seeing when I meet with a couple, I'm typically looking at a premium that's going to be right around $2,400 a year. And that's not for each of them, that's together. If you are a single man, policy will typically cost right around $1,500 a year. And for a single woman, it'll typically cost right around $1,800. People always ask me, well, why is it more, does it cost more for women than it does for men? And the reason that is because, again, long-term care or the need of long-term care is much higher for women than it is for men. And so if you looked at life insurance, for instance, and John and Mary were both 55 and they bought a life insurance policy and they were the exact same age and the exact same health, life insurance would cost John more than it would cost Mary, and that's because men die sooner. Long-term care costs Mary more than it does John. So that's pretty much it. But the next thing to do is to get in touch with me. That's my cell phone number on the screen. You can send me an email, and when I hear from you, I'll give you a call back on the telephone. We'll literally spend 5, 6, 7 minutes on the phone tops, where I'm just going to gather some basic information from you about your health, your family history, and then I will be able to email you out appropriate material, including quotes. And then once you get that email, I typically go over how the quotes work with people when they need it, actually, in 25, 30 years, and then that way you'll be able to make a decision on whether or not long-term care is right for your particular situation. So I want to thank you for listening to this webinar today, and with that, I'm going to turn it back over to Craig. Thanks a lot. Look forward to hearing from you.
All right, thanks, Tom. If you'd like to learn more about this program, some of the carriers that are available through this, or just do a little bit more learning before you want to talk to Tom, we have set up a great educational website at educatorsltc.com. Once again, that's educatorsltc.com. You can go on there and learn. You can also share that link with friends, with a spouse that might not have been able to attend the meetings or attend this webinar. You can also schedule a 15-minute initial consultation by phone with Tom by simply going to educatorsltc.com/Tom. So once again, a 15-minute consultation, you can schedule that online. It'll plug it right into his calendar. You can find the time that works best for you, that's most conducive to your schedule. Just go to educatorsltc.com/Tom. Thanks for your time today, and if you have any questions, please give us a call. Thanks.